Okay, we'll get started shortly. It looks like it's already 1 minute past. We'll give it about another 45 seconds for everybody to get connected. Right, this is interactive. This is a math class, so it's easiest if you have Excel and open on one monitor, or at least a calculator or something, but you're going to need some Excel for the exercises or something to do your math on. All right, and we're 2 minutes past, so I think, Paige, you can hit the record button and we'll get started with our disclaimers.
Perfect. All set when you are.
Thank you. All right, then. So please note that we are recording this today, and thank you for joining us. This is Mortgage Cadence's Mortgage Math series, the first of our installments. I have to be honest with you, I'm not sure that this one's the most interesting one. They do get more interesting, as much as I can make math interesting for you anyway. I am Melissa Kozicki. I'm the Director of Compliance here at Mortgage Cadence. I do have to tell you a couple of quick things before we start. First of all, I'm not an attorney. Nothing I should say should be construed as legal advice. The information in the document and the presentation are for educational and informational purposes only. So we are going to be posting our recordings for our clients. You can contact us on the last slide. If you're not a client and need a recording link, we can see what we can try to do. So again, this is interactive. I'm going to turn off my video so it's just not distracting and sucking up bandwidth for the presentation. Please feel free to control your own muting. If you want to shout out the answers when you know them, I'm fine with that. If you're more comfortable putting them in the chat, that's fine too. But please help keep it fun by being interactive. So I'm going to stop my video and start my content. So we're going to start really basic here. And I will point out that the premise of our series is basics. So for those of you who are new to the business, we're going to go right back to the beginning. So what is amortization? That's what we're about today. We're going to do some definitions and practice exercises for amortizations and interest. Amortization is the process by which you borrow some money and you pay it back. The fact that it's amortized means that when you're done paying it back, you've paid back the principal you initially borrowed plus the interest that's due. Okay, simple interest is just that. It's a way of calculating interest based on the period that it's outstanding for a given period of time. Okay, that principle. So those are two of the things that we are going to look at. So let's do an example. Now, when you see in these boxes, when I have something like this, equals, whatever, those are my Excel hints. So if you would like to type something into Excel in your other spreadsheet or your other monitor, you can do that. But the idea of calculating amortizing a loan is a portion of your payment is devoted to the principal, meaning that chunk you initially borrowed, and a portion of that payment is devoted to the interest, meaning the cost for having borrowed it. So in most types of payments, amortizing payments, each payment that you make to your creditor is a little bit of both. And so the first thing you need to do is figure out which is which part is interest and which part is principal, so that you can understand what you're working with. And so here I've given you the payment formula in Excel. I'll point out, if you really like doing your Excel, it can be a little more complicated. For instance, I tend to round my Excel payments, but that's the basic payment function. And so that would have yielded us a payment on this loan with these terms of $961.14. Then we look at it and we say, well, how much is principal and how much is interest? Interest is really simple. Interest is just loan amount times rate divided by 12 months. That's it. It's a very simple calc. So were we to do that here, we would do exactly that. We'd say, okay, 125 grand at 8%, or I guess up here I have 8.5, so a little inconsistent there, sorry, is this much. And so if my payment is this much, right, minus this, that's what gives us our math. When we make our first payment on this loan, $75 to principal, everything else went to interest. And that $75 is all that we're reducing that principal with, that amount we owe, that chunk of initial principal, the loan we borrowed. That's all we've almost $1,000 payment. That's all we've reduced it for. It's all that the principal got came down. So if we look at that, let's do this together. And so I'm going to open up the chat. So hopefully somebody wants to guess, right? What's the first question? The first question is, what's the interest? We just did it. We just looked at it. Same thing. So if you've got the interest, I've given you the payment. All I'm asking you is, of this $997.95, how much is interest? So you're going to take your loan amount times 7% divided by 12 months, because you make one payment a month. There's 12 payments in a year. What's the answer to that? $87.50. Very good. Just a decimal off. Yeah. Oh, I'm sorry. I read it off. Yes. 875. Exactly right. Perfect. And so the balance of that, what's my principal? The balance of that, 997.95 minus the 875 in interest, whatever's left over is what goes to principal, right? So only 122.95 went to principal. So what's my balance after my first payment? Very good. Yep, you got it. And so my balance, I would take my principal minus this principal payment, and it would leave me with you got it. Perfect. Very good. You guys are getting good. Okay, so that's it. So that's how much I owe now. I'm going to carry that to my next month, and I'm going to do it all again. Okay, I'm going to give you a second to think about that, right? And so what am I going to do now? Month 2. What's my interest? It's going to be the same, right? You don't need to calc it again, because it's going to be, we're an amortizing, or I'm sorry, it's not going to be the same, because we're an amortizing loan. We're taking this balance each time. So you're going to do the same calc, but not the 150,000, right? So we would have taken this balance times 7% divided by 12. That gives me my interest. Whatever's left over is what gives me my principal. Very good. Yep, you got it. Now I jump ahead here to month 36, because I want you to see the process of the amortization. So do it again. What's my interest? What portion of this payment is interest if this is the principal we're working with? So now we take our 145 to 41.29 times 7%, still at the same rate. That's going to tell me how much is principal and interest. Good. 847. Very good. With the balance going to principal. The reason I wanted you to come through month 36 and now month 288 is I want you to take a look at how this amortizes, right? So just a teensy bit of my payment in the beginning is going to principal. Even 3 years on, we can see it's still not a significant amount going to principal. Here, month 288, right? It's a 30-year loan, 360-month loan. We're finally seeing, much more of that payment going to principal. Very good. 345.27. Good job, guys. Okay, so that's how we see this amortized. And this is the process. I mean, Excel will make it a lot faster for you, but this is what we do. As we go through our courses in this 6-part series, we're going to show you how you actually use this to validate your APR, how to hand calculate your payment stream, your QM APR, all that fun stuff. But this is the foundation. So I'm going to go to the next slide, but if there's any questions, I'd prefer to address them before we get too far. So feel free to put them in the chat. You can also unmute yourself if you want, if you have the ability, and ask your question. I don't mind. Taking that same example, let's talk about applying extra money to principal. We always hear people say, well, if you pay a little extra each month in your payment, you'll save money in the long run. What does that look like? Same loan we just did, but in this case, my borrower is putting in an extra $100 to principal every month. Okay. And so instead of the 122, 123 going to principal, we see they started with month 2, putting an extra $100 in. So when we get to month 36 in this example, okay, it had been only 150 going into principal. Now they're at 272. The end result here is that in this example, with $100 a month in their payment, they paid it off 7 years early, which doesn't sound like a lot to me, frankly, on a 30-year loan until you look at the numbers. It means they spent or saved an additional $58,000 in interest. Okay, so just 7 years knocked off 58 grand. They would have had to pay the principal payments anyway, right? The principal always gets repaid. They just prepaid a tiny bit each month. So it's something to think about as consumers even, how much we are impacted by those additional payments to principal. Now that's an amortizing loan. Some loans have interest-only payments. So for instance, HELOCs, construction, any loan can have an interest-only period. You could, for instance, have whatever, a 30-year fix that you decide you're going to have an interest-only payment on. You can do whatever you want. I'm not saying that you should, or that you can sell it, or that Fannie Freddie will buy it, or that it'll be QM. I'm saying it happens, right? We still see loans with IOs. So let's look at how that would work. It's exactly what we just did, so it's not as time-consuming for us to review. An interest-only payment is only interest. And so you're just taking the loan amount times the rate divided by 12. That's it. That's what gets us our payment, okay? So now this is the same loan that we amortized, okay? Same concept, 150,000 times 7% divided by 12. There's our 875, okay? But what I did here was I gave it a 3-year IO period. And look at how it amortizes now. It's really a short interest-only period, didn't make a huge difference. Here in month 288, we're applying 678 to principal. Well, as opposed to without the IO, right? It was 652. And when we paid it off, we had a different balance here, right? It was certainly a lower balance with no IO, but not a huge difference. The key here is that when you're making interest-only payments, you see you're not reducing your principal. So whatever that IO period is, you don't start amortizing until it's over. Now, the other, let me just pause for a moment. Were there any questions on that, on interest only, before we get to prepaid interest? Amortization, interest only? Does anyone have any questions on that or how that works? That's how you're going to do it for everything. When we get into ARM loans and how to do the QM APR, the first step is running your amortization. So that's what you're going to do. It's actually going to be much easier for you if you're going to start incorporating this into your daily lives to open up an Excel spreadsheet and just copy down the formulas so that you just have to enter the data once. And we can answer questions about that too if you try it in between now and the next class and have any issues. Okay, then interest in itself is really interesting because interest is paid in arrears. And that to me was very difficult to wrap my head around when I first started. So what we're saying is that when you make your payment, your May payment, for instance, your mortgage payment, you're actually paying April's interest. Okay, it's always paid in arrears. And because of that, you're going to end up with a few odd days, we usually call them, that has to be collected at closing. So you prepay those odd days at closing, and it's reflected on the LE and CD. We as an industry tend to be a little loosey-goosey with our acronyms and how we refer to things. Per diem technically is per day, meaning in this example here on the LE, the 1744 per day. We often say per diem meaning the whole total, or we might say odd days. Okay, so there's a couple different ways to refer to that. Why does interest being paid in arrears explain odd days? Let's look at an example. And let's think about how you calculate it. Now, I'm not going to go too much into detail, but I want you guys to be aware that if you are trying to back into this, you need to know what your system is set at. So if you're QCing your file, if you're doing compliance on it, if you're just checking a figure or doing a hand calc, there are a lot of different ways to calculate interest. Meaning there's two numbers or two data points. For instance, actual 365 means use the actual days in the month. So for instance, actual makes a difference in February. In our calculation, we use 28 days as opposed to 3365. We'd use 30 days, even if it were February. Okay, so actual means look at the date and use the actual number of days. And that's true for the month or the year. Like I could not get one of my calcs to match a while back. And I finally realized, I think it was 2020, it was a leap year. I was just off a couple cents and it was driving me nuts. It was because I wasn't using 366 days in an actual calc like I should have been. Okay, so that'll get you every 4 years. A lot of 3360 is probably the most common. A lot of people just default, don't care what the month is, just pretend it has 30 days. Don't care about reality, just use 360 days in the month. That is the most common. But it's really important that you know what your system is set at to be able to match it. And here's the Excel formula for per diem. We'll see it again. So I asked the question, why does it matter that interest is paid in arrears when talking about odd days interest? Because the lender is not doing this out of the goodness of their heart. They are lending you money and collecting interest on it, right? That's one of the ways they stay in business. And so if you closed a loan on January 15th, your March 1st payment is interest for February. Well, what happened to the days between January 15th and January 31st? Those are the odd days we're talking about, and those need to be collected at closing. Okay, that's where we get the odd days from. Let's reverse it before we do an example. A practice. What about an interest credit? What are those all about? Well, usually it's only allowable if you close and disperse within the first 5 days of the month, but let's take the same kind of example. Instead of January 15th, the loan disperses January 5th. And instead of a first payment in March, we have it as February 1st. When the borrower makes their February 1st payment, they're paying interest for all of January. So now what happens? They just paid interest from January 1st to 4th, days they didn't have the money. That means the lender owes it back to them. That's how we get an interest credit. It only occurs in those scenarios where you've got a closing and then the payment doesn't skip a month. It's the month immediately thereafter, like this. Any questions on interest credit? I want to make sure that I explained it in a way that everybody can understand, because I feel like it's sometimes confusing to them, to us all. Does anybody know why interest credits are generally only allowed in the first 5 days of the month? Anyone want to guess? Is there a regulation that limits that? Oh, really good question. Would there be no credit if they closed on the 1st? Yes, that's exactly right. I didn't address that. That's a beautiful question. That's exactly right. If this loan dispersed January 1st and the first payment was February 1st, no interest at closing, no odd days. The lender wouldn't owe the borrower. And when the borrower made their February 1st payment, they would cover all of January. It's a really good question. And the answer to why the first 5 days of the month is purely logistics. It generally just takes that long to get the loan dispersed and closed and shipped and booked on the servicing system so that it's ready to accept the February 1st payment. There's no particular rule that you couldn't do an interest credit on the 6th. It's just not, I've never seen it done. It's generally a logistics issue. So let's do a couple of activities. So now if the first payment is May 1st, okay, and we're using an interest method of actual 360, the first payment includes interest for April. In this example, my loan dispersed March 5th. So how many odd days do I have? March 5th, I'm doing actual days. That's my interest method. Okay. 26 days. I've got 27. Let's count them out. So the one thing I want to make sure that you caution, yep, 27, good. If you use an Excel formula, I've done this to myself a million times. You do something clever like say, hey, take the 31st minus the 5th. It'll give you 26. But remember, the borrower got their money on the 5th. They need to pay interest for the 5th as well. So 27 days if we include the day they got their money. So that's great, 27 days. Now, when I'm doing my per diem calculation, I'm using actual numbers of days in the month. So I'm using 31, right? So all my loan amount times my rate divided by the number of days in a year. In this calc, I'm doing 360 times the number of days gives me what? Per diem. We already said the number of days is 27. So what's my per diem? Yep, good. 14 times 38 or 0.38 times 27. Perfect. That's exactly right. 382.41. We might have been off by the number of days. So again, let's just double check because this is where you're going to be off like a day or two or $1 or $2. So we're going to take 115 times 4.5%. That part's easy. In this case, we want to divide by 360. Why? Because that's what the lender said on this row. That gave us our 1438. 1438 times 27. 88, 13. Perfect. Now let's do it again. If the first payment is May 1st, first payment includes interest for April. How many days do we collect at closing? We're doing 3360. Now I will say I've seen this go, yep, 26. I've seen this go a couple different ways, how lenders chose to address this. You do always have to check with your settings in your system, your company policies. There's a million nuances. I'm not sure I could possibly cover every scenario. I was already using 360 for my year, so my per diem stayed the same. But now I've got that 373 you were expecting. Very good. All right, and then our last one, what do we have here? If the borrower is paying first payment April 1st, closed March 5th, their first payment of April 1st includes interest for which month? Yes, exactly, March, because it's always in arrears. It's always going to be the month before. So now they're paying for March. Okay, loan closed March 5th. First payment April 1st. How many days should I be collecting at closing? Yes, very good. 4, -4 technically, because I'm not collecting it, I'm refunding it. So for those of you who are not familiar with an interest credit, you are closing your loan on March 5th. Somebody's handing you a big old bag of money on March 5th. That means your interest payments starts accruing. You start owing money the minute they cut you that check, like literally that minute. Okay, and so that's where we get your April payment includes all of March's interest. So the least they can do is give you back these 4 days you didn't have your money. Okay, this time we're using 3365. Yes, very good. Somebody put the per diem in earlier, 1418. I wasn't too fussy about my rounding here, so we might be off what I call the killer penny. That's a whole other conversation of whether you use standard rounding or what precision you use. But yeah, that's the difference, right? When you're using 365 days instead of 360, your per diem is going to be a tiny bit less, your amount per day. So times -4, we're going to pay the borrower $56. Right? That's how you work interest of any kind, really, that's interest only. I want to talk very briefly about, very good, 5671, you got it. I want to talk briefly about construction interest. Construction is very lender specific, right? You may have a lot of very specific policies, but it's basically the same concept that we just talked about. Construction is by definition interest only payments. You will make your payments based on how the lender has it set up, whether they want to collect on the amount outstanding, the total commitment. There's a lot of nuances. And that payment also can vary by the number of days of the month or the year. And you really have to watch your dates when you're hand calculating construction, boy. So here's an example. And I think we have an activity too, but it's the same concept. It's loan amount times rate. That gives you your annual. And then you just figure out what your per diem is. That's how you figure out your monthly payment on a construction loan. Again, whether it's the full commitment amount, the amounts outstanding, the number of days, it's always the same calc. Okay. So the question then is there any per diem on a construction loan? Maybe, but not that I've ever seen. What if they get a draw in the middle of the month? Yeah, that's going to depend on it's going to depend on how you guys are calculating it. So for instance, most construction lines, and the question really isn't just if they get one draw in the middle of the month, right? It's probably like, what if they have multiple draws in the month? So let's say, in answering your question, let's say they draw $1,000 on May 6th and $1,000 on May 9th, then you're going to end up charging them, what, 33 days for the $2,000, this plus this, right? And then an extra, I think I just said the math wrong, but let me say it again. So you're going to charge them, you're going to start charging them on the 6th, 25 days, 26 days, you'll charge them for $1,000, however long that was. And then 9 by 31. So however many days, 20, whatever days, you'll charge them for the second $1,000, meaning whatever your billing cutoff is, you look at each draw and you figure it out independently. And with construction, it gets really confusing because it fluctuates. So what if they had a draw here, and the rate changed on the 15th because the rates went up? So you usually go through and the way I do it is I kind of make a little column of where the draws are, where the rates are, and then I just calc each one of those for the number of days individually, and then add them all up when I'm figuring out the payment. Because you really have to watch both the draws and the rates for that. Now, normally in per diem, in constructions, when we close them, we don't usually charge per diems. We have one or two things that we can do. A lot of times what I see, so in this example, 415, first payment of 6/1. Okay, it's all the same calc, so I'm not going to make you do them. But what we do is we charge them 30 days for their first month, plus the odd 16 days. So their actual first payment is like 46 days in total. I see that most often. I don't usually see it go all the way out to June 1st. Usually what I would see in this scenario is a 415 closing with a 5/1. Or a lot of times their first payment could have been 515, and then we wouldn't even have any odd days. Their first payment would simply be the 30 days. And we'd multiply by that 1222, if that makes sense for the construction. I want to be respectful of our time because I think we are just exactly at time, but I have a moment if anybody would like any questions, has any questions.
Melissa, we had one question in the chat said, what if they get a draw in the middle of the month?
Yep, and that's where I went on my tirade about both the days and the rates could vary in the middle of the month.
Perfect.
Yeah. So yes, I don't know if I really answered Diane's question, but it did make me think of what same question for the rates. So we can look at it again. But you would just do them, you would basically do this, right? And so you would say, well, again, that would be assuming that you're only charging them on what's the draw, right? So if they had an $80,000 draw, you do the math. And then if they had a $5,000 draw, well, then they would have $85,000 outstanding and you do the math. I did answer it. Okay, good. Wonderful. Well, I hope that you guys will all join us. Our next one is ARMS, more interesting than it sounds. Also, rate environment is changing, so it might be good even if you're not doing them now. So you come back and make sure, if you don't know if you want to join, answer yourself if you could figure out your payment stream based on both the caps and the fully indexed rate, FIRA. If not, then be sure to join us next week and learn how. Thank you, everyone. And I think you can stop the recording page.